Okay, the 2014 ratios question. The usual things to check. Work out your 5% preference shares. So 5% of 100,000 is 5,000. Check where the interest is in relation to the profit. So you've got net profit for the year is before or is after your interest, so that's right. Maybe highlight your share price. You can see straight away, by the way, the share price from last year is higher, so this probably isn't going to be good. That's often a good way of checking when you're going to take a positive or negative slant to this. Just check the share price. Maybe go down and see what you're asked. So you're advising the bank manager for a loan of 350,000, in which an interest rate of 9% should be charged. So you're given specific information on the loan, which is going to be important, especially around our gearing and our liquidity and even our profitability a little bit when we come to do our report. Part C is fairly straightforward. We'll explain that as we go. So usual thing, we'll do our 5 ratios. So the first one is to work out the cash sales if the period of credit given is 2. So period of credit given to debtors is debtors over credit sales. That's the formula. So debtors by 12 over credit sales equals 2. You can flute around with this, but 2 times credit sales is going to be equal to debtors by 12. Debtors is given in the question, 43,000. So 43,000 by 12 is 516. So credit sales is 258. And total sales is 950. So total sales is made up of credit and cash sales. So therefore cash sales is total minus credit, which is 950 minus 258. So hopefully you're getting the hang of those ones. Return on capital employed, net profit plus interest over capital employed. So 470 or 47 plus 18. Capital employed is the last number, 792. And that gives you 8.21%. Earnings per share in 2013. It's the other thing to be careful of, by the way. Sometimes they will, in some of the older questions, they ask you to work out a ratio from the previous year, from the information in the box. So always just check that the year matches up. It'll only be one of them. But anyway, earnings per share is net profit minus preference dividend over issued ordinary shares. So 47 minus 5 over 350 is 12 cent. And then it's nice and easy. Number 4, the dividend yield is dividends per share over a market value of 1 share. So we need to work out what dividends per share is, which again is ordinary dividend over issued ordinary shares. Ordinary dividend is total dividend minus preference. So 40 minus 5 is 35. 35 over 350 is 0.1. So 0.1 euros or 10 cent. So the dividend yield then will be 10 over 130 by 100, which is 7.69. This last one then, how long it would take one ordinary share to recoup its market price based on present dividend payout. So that's the formula I told you to write down extra on your sheet. So it's market price over DPS. If you're asked on present earnings rate, it's the price earnings ratio you use. If you're asked on present payout rate, dividend payout rate, you use DPS. So it's market price either over EPS or DPS. So in this case, it's dividend payout rate, so it's over DPS. So 130 is the share price, 10 cent is the year, so it's going to take 10 years to get your money back. So that's part A done. Okay. The report then, bank manager, whether he should give a loan. So at the end of it or at the start of it, one way or the other, you have to say, yes, I'll give him a loan, or yes, I would advise the loan be granted, or no, I do not advise the loan should be granted. Now, as I said, you're given specific information about the loan and its interest. So we need to try and get this information in, and particularly in the liquidity and gearing. Gearing is going to be a big one to show that the gearing is going to be much worse as a result of it. You can also, it's also a good idea to refer to it in relation to profitability. So our layout is going to be the same. Keep following the same process. Follow the sheet. Okay. So profitability. Shannon Limited is a profitable company. That's always our first line with a net profit for 47,000. Okay. We've worked out the return on capital employed to be 8.21. which is down from 10.1, a negative trend. Now it's above the risk-free rate of return, but it's below the cost of borrowing. So when they give you the rate of borrowing, it's the company giving the loan, so the profitability is below the cost of borrowing. You could say it's above the debenture rate if you wish, but below the cost of borrowing. So they're not making the most efficient use of their resources. And I want to refer to the fact that they're borrowing money at a higher rate. The company will be borrowing at a higher rate than their profitability. That should get us the marks. The dividend policy. So I'll go through my usual. Dividends per share, which I worked out, is 10 cents and it's down from 12 cents, which is a negative trend. Dividend yield, 7.69, which is down from 8.9, another negative trend. Again, explain what dividend yield is. I want to say that the yield is below the cost of borrowing. Again, I just want to try and refer to the borrowing again. So you know that dividends are to do with shareholders, so you can't really say anything about the bank. So what I said was that the dividend yield is below the cost of borrowing, so shareholders might question the point of the loan. Okay, so it's tying in that you know shareholders and dividends go together. Dividend cover is the important one, 1.2 times, which is very low. So last year's dividend cover was 1.25 times, so that's a negative trend. It's very low, and not enough money has been kept in the business to fund expansion or cover any future loan repayments. Again, referring back to the point that it's a loan. Okay. So then you're into the main ones for when they give you a bit of information. You're looking at liquidity and gearing. So asset test ratio 0.45. Now as soon as you see that, you can't give out a loan. So just be aware that you're going to have to say no to the loan. Down from 0.9, so they were already in trouble, but now it's a negative trend and it's well below the ideal of 1:1. Usual line about being 45% of liquid assets for every 1 year of short-term debt. They will have difficulty paying the short-term debt as they fall due. Now, I want to then refer to the loan again, or to the interest on the loan. So they're going to have difficulty paying the future interest payments on the loan as a result of their poor liquidity, and I want to say that it's highly likely that their liquidity will worsen if the loan is granted, because they'll have a whole heap of loan interest due that they have to take into account. Okay, so again, referring to that loan again. Probably notice I'm not writing in anything about the current ratio because I haven't seen it in 10 years, 15 years now in a marketing scheme. Gearing and interest cover. Now this is where we have to up our game a bit. So gearing of 50.5%, so I've obviously worked that out. 300 plus 100 is 400, over the 792 is 50.5. That's up from 48% last year, which is of course a negative trend when it increases. It's slightly worsened, don't have to go too overboard in it, and they're now highly geared. So again, always refer to them being highly geared or lowly geared, and explain what that means. Funded more through long-term debt than equity. Okay, and it is dependent on outside borrowings. So if they're highly geared, they're dependent on outside borrowing. If they're lowly geared, they're not dependent on outside borrowing. Now, next job, you show what the gearing will be afterwards. This is a loan for the company. It's not for a loan for someone investing in the company. So it's important. So in the last question, we had a fella borrowing money to buy shares. That doesn't affect gearing. That's his own position. But if in this case the company is borrowing money, well, their debentures or their loans, their long-term debt will go up by 350,000. So presently it's 300 plus 100. There's another 350 to be added in. Of course, that 350 also gets added in here onto the 792 because it's 300 will go up to say 650. 650 plus 492 would be whatever would be 1042, which is very high. So I worked it out and I got 65.67. That's very high. So it's very important that I refer to what my new gearing will be. Interest cover presently is 3.61 and it's down from 4 times, which is a negative trend. Again, interest cover is the number of times that interest can be paid out of profits. And currently they're in a position where they can pay their interest, but the falling interest cover, along with the poor liquidity, and along with the profitability falling, will worsen. Or it's going to get bad. So will worsen if the loan is granted, and with falling profits, the company might struggle to make future interest payments. So again, keeping that negative tone in relation to the loan. Security and fixed assets. Their fixed assets are valued at 790, and again, you put in a line that it's hard to. We would like to ascertain the company's depreciation policy. We'll talk about our investments. So our investments are 210,000, but they're now only valued at 200,000, and that says something about poor financial management. Of the tangible fixed assets of 480,000, there's already 300,000 of them secured, or there's already 300,000 of debt secured against them. Okay, so that only leaves 180,000, and we want to take out a loan of 350,000. So it doesn't leave enough assets to secure the new loan against. Okay, so again, you definitely won't give a loan in that scenario. The sector, now I have to come up with something negative. I'm just thinking about you lads for your leaving cert, so this probably won't be anywhere near what the marketing scheme says, but again, they're in the construction sector. Now I was like, what negative can I say about the construction sector? There's a couple of things I could say, I suppose, for you. In the short term, the industry can expect to suffer due to COVID closures. And I was thinking, well, what else can I say? I would need to bring that on. There's emigration of many workers to the UK. That's actually true. A lot of construction workers have gone to the UK, where work is open. But in the long term, I need to come up with another negative as well as a positive. So in the long term, I was like, well, I need my positive. So there should be demand for housing and future construction and savings that are an all-time high. So any business for you lads that is in anything major, the car industry, kitchens, anything that there's significant cost to, should bounce back fairly quickly. But I wanted to say that Shannon Limited may not survive long enough. So I got my second negative in there. Okay. So on that basis, the last thing is always write about the purpose of a loan. If we're giving a loan or we're granting a loan, we have to write about the purpose of the loan. So what are they doing? They're in the construction sector. It tells us here it's just for future expansion. Now that should be a red rag because that's over trading, but we just can say that the loan is for future expansion. It doesn't say what they're expanding into, it just says future expansion. So I'm going to say that there's not enough specific detail there, because there isn't. Now they already have poor liquidity, and future expansion could lead to further overtrading. So overtrading is where you're doing too much business for the size of your company, and that's a really, really bad thing. It creates liquidity issues. So I wanted to get that in because it's an accounting term. So then for my conclusion, they should not grant the loan. Okay, part C, which obviously I should have explained to you at some stage over the last couple of years, but definitely haven't. The difference between liquidity and solvency. Think of your liquidity ratios. What do we always say with the asset test ratio? It's your ability to pay your short-term debts as they fall due. That's what liquidity means. So liquidity measures a company's ability to pay its short-term debts as they fall due, and it's measured by the asset test ratio. Solvency is ability to pay any of your debts as they fall due, short or long. And we can say that a company is deemed to be solvent if total assets are greater than outside liabilities. So what we mean by outside liabilities are debentures and preference shares. Ordinary shares and profit and loss are also liabilities, but they're internal liabilities. So your outside liabilities are your debt capital in reality. So you need your assets to be greater than that, because your assets will never be greater than your liabilities. They'll always be equal. That's the whole point of the double entry bookkeeping system. But we need our assets to be greater than our outside liabilities. So 790 is greater than 400. So they're solvent. So solvency is an ability to pay all of its debts as they fall due. Okay, and that'll get us the full marks there. So hopefully that was of some use to you lads, and I'll keep going with these. I'll probably get another 2 or 3 done over the holidays, and we'll see you when we're back.